Changes in accounting estimates, more examples. Lots of questions will ask you. What type of change? What is this a change in accounting estimate or principle? Well, if any of these are listed, these will be changes in accounting estimates. So changes in the estimate of uncollectible receivables. Inventory obsolescence, maybe your iPhones that you were carrying as inventory, if you're an electronics store, they decline in value much faster than you thought they would. Useful lives and salvage value of assets, we talked about that one. Periods benefited by deferred costs. So if your costs that you defer, right, that you don't pay yet, they're not going to benefit as many periods in the future, like prepaids and accrual-based costs, liabilities for warranty costs and income taxes, recoverable mineral reserves, and change in depreciation methods. All of these, anything that you have to estimate because you don't know it as of right now, these will be changes in accounting estimates, which will happen a lot because you need to constantly update your financials to be as accurate as possible. And if they're not, that's not good. So you need to change your estimates as much as possible. All right, now we talk about changes in accounting estimates, and you see that they are reported prospectively. Because that makes sense, right? Like you're not going to go back and because that was your estimate in the past. It was an estimate. You just change it going forward, prospectively in the future. Changes in accounting principles were retrospectively. If you completely change how you're doing your financials, you got to go back and restate them all. This is just going forward. So account for changes in estimates in the period of change if the change affects that period only. So if it's just an estimate that affects this period only, then do it for just this period. The period of change and future period if the change affects both. If your estimate is that you are going to pay $1 million in liabilities, in lawsuit liabilities every single year, and you had it at 500 before, well, now you gotta change those future periods. FASB views changes in estimates as normal recurring corrections, wrong word there, and adjustments, and prohibits retrospective treatment. Right, and why do they do that? Well, this is because it just makes sense. Do what makes sense. I know there's a lot of rules, and you're like, what the heck? This is a lot. I don't like it. And I'm with you. I don't like it, right? It's not fun. But a lot of this does make sense. Like there's a reason for it, and it benefits the users of the financial statements. Here's an example for a change in accounting estimate. Let's read through. So I'm going to highlight what was the original information, and then let's see what's the new information. Well, Mackenzie Academy purchased a truck for $640,000, which at the time had a 10-year useful life and a salvage value of $40,000. So that's all the original information. Awesome. Depreciation has been recorded for 7 years already. All right, so that's locked in. That's happened already. But in year 8, it's determined that the total estimated useful life should be 12 years. So it went from 10 years to 12 years, not 12 additional years. It just went from 10 years to 12 years with a salvage value now of 10. So two things changed. Not only did the useful life change, but also the salvage value amount changed. At the end of that time, what is the journal entry to correct the prior year's depreciation expense? Also calculate depreciation expense for year 8. Now, we just do this, remember, in the current period and going forward, prospectively, right? We just do it going forward. We don't have to worry about the past. So now let's do the calculation. We originally had 640, subtract out salvage value. That gives us a depreciable base of 600. This is the original amount we were going to depreciate. And if everything went to plan, it was going to be over 10 years, which is $60,000 a year times 7 years. Well, it would have been 10 years, and that would have been the full amount. But so far, what has happened? We did $60,000 a year for 7 years, which means that our total depreciation, accumulated depreciation, sits at $420. All right, so what do we do from now? Well, at the end of year 7, this is our net book value, our carrying value. Awesome. So this whole slide is just showing what has happened so far. So you need to calculate what has happened so far in order to continue onward and see what we should do in the future. Now that we went through and completed the prior to the change in estimate numbers, let's see what we continue to do going forward. Well, we carry forward that 220 of net book value that we ended up with here at the end of year 7. All right, so then we update that based on the new salvage value, which is 10, right? 10 was mentioned, that's the new salvage value. So now we have a new depreciable base of 210. This is kind of like a reset. And then how much useful life do we have left? Well, originally we had 10. We completed 7 years. Okay. Now we really had 3 left, but then they added 2 on because it's now 12 years left. So that's an extra 5 years remaining. We have more to go. So that means 210 is going to be depreciated over the remaining 5 years. Annual depreciation is 210 divided by 5 is 42,000. This is now our depreciation expense journal entry for year 8. We're just plugging along, going forward with these new numbers. This is a great accounting estimate change question as well as a great depreciation question. You can see it in both of those sections. Another note on our changes in accounting estimates, on disclosures for them, about talking about them, we shouldn't disclose anything that's not material, right? Remember the concept of materiality. Users of the financials really just want to see what's material. So if we have a $100 change in depreciation or inventory obsolescence in a billion-dollar company, that's, yeah, sure, we'll change the numbers if it's even worth our time, but we're not going to disclose that. No one cares because it's a billion-dollar company, it's a $100 change, and that's not important at all. For an estimate change that affects many periods, such as the change in service lives of depreciable assets, companies should disclose the effect on income from continuing operations and related per share amounts of the current period. This is just another item of disclosures, what you need to disclose, talk about more in those financials.